Imagine waking up tomorrow and discovering you owe $10,000 you can't pay. Now imagine owing 10 trillion. That second number doesn't feel real. It doesn't even register as danger. It feels abstract, like monopoly money. And that reaction is exactly the point. Because when individuals owe too much, it's a crisis. When governments owe too much, it's called policy. Right now, the world is carrying more than $300 trillion in debt. That's not a typo, 300 trillion. And yet markets aren't on fire. Governments aren't being dragged into court. Life goes on. So why doesn't global debt work like personal debt? And more importantly, what happens if it suddenly does? This matters right now because interest rates are higher than they've been in years. Governments that got used to cheap money are now paying real bills, quietly, in the background, while everyone argues about inflation, housing, and wages. Debt is the invisible engine behind all of it. To understand why trillions don't behave like your credit card, we need to start with something uncomfortable. Money itself is not what you think it is. When you borrow money as a person, the rules are simple. You earn income, you spend less than you earn, you repay debt with money that already exists. If you don't, you default. The lender loses patience. The system snaps shut. Governments live in a different universe. They don't just borrow money, they help define what money is. When a government issues debt, it's not knocking on a door asking for cash, it's creating a financial asset, a bond. That bond becomes something banks hold, funds trade, pensions rely on, and central banks treat like bedrock. Your debt is a liability. Government debt is also infrastructure, and that changes everything. Here's the first big difference. A government that controls its own currency cannot run out of money the way you can. That sounds dangerous, and it is, but it's also true. If a country borrows in its own currency, it can always create more of that currency to pay its debts. The US issues dollars, Japan issues yen, Britain issues pounds. They don't need to earn these currencies first, they issue them. That doesn't mean there are no consequences, it means the consequences are different. Instead of default, the risk becomes inflation. Instead of bankruptcy, the risk becomes currency weakness. Pain spreads quietly across prices and purchasing power, instead of arriving as a single dramatic event. That's why governments can carry debt levels that would instantly destroy a household. But that's only half the story. The other half is who they owe the money to. A surprising amount of government debt is owed internally, to domestic banks, to pension funds, to insurance companies, sometimes even to their own central bank. In Japan, the government owes more than twice the country's annual economic output, and yet Japan hasn't collapsed because much of that debt is owed to Japanese institutions held in yen, backed by a central bank willing to intervene. It's less like owing a loan shark, more like owing your own reflection. But reflections can distort. Here's where the math starts to get uncomfortable. Debt doesn't just sit there, it compounds. When interest rates were near zero, governments could roll over massive debts cheaply, borrow to pay old borrowing, kick the can, no panic. Now, rates are higher. That means trillions in existing debt are being refinanced at much higher costs, not tomorrow, not all at once, but slowly, relentlessly. Interest payments rise before anyone votes on them, and interest doesn't care about intentions. At some point, debt stops being a tool and starts becoming a tax on the future. Not a visible tax, not a bill you see, a silent one, paid through lower spending, higher inflation, or crowded out public services. This is where the myth really breaks. People often say, governments don't need to pay back debt, they just roll it forever. That only works if three things stay true. Growth stays strong, borrowing stays cheap, and confidence stays intact. Lose one and the system strains. Lose two and you get instability. Lose all three and history gets ugly. We've seen this movie before. In the 1970s, governments printed and borrowed aggressively. Inflation exploded. Trust cracked. In the 2010s, borrowing surged again, but inflation stayed asleep. Central banks became heroes. Debt felt free. Then came supply shocks, rate hikes, reality. The system didn't break, but it groaned. Here's the irony. The same mechanism that makes government debt feel safe is what makes it dangerous at scale. Because there is no hard stop. Households are forced to stop. Companies go bankrupt. Governments can continue long after the warning signs flash red. Which means problems build quietly. Debt doesn't kill countries overnight, it changes behavior. It narrows options. It turns future growth into present obligations. More money goes to interest, less goes to innovation, resilience, or mistakes. And eventually something gives. Sometimes it's inflation. Sometimes it's austerity. Sometimes it's social unrest when people realize the promises don't match the math. Global debt doesn't work like personal debt because it's woven into the system itself. But that doesn't make it harmless. It just makes the consequences harder to see until they aren't. The uncomfortable truth is, the world has built an economic system that assumes tomorrow will always be big enough to pay for yesterday. So here's the real question. What happens when tomorrow stops growing fast enough to carry the past? Because when trillions finally behave less like policy and more like debt, the adjustment won't feel abstract anymore.